Hi, everybody. Thanks for joining us for another quick hit with Complete Intelligence. My name is Tony Nash. Today, we're joined by Brent Johnson. Brent, thanks so much for joining us. Can you tell us a little bit about who you are and what you do for the people who don't already know?
Yeah, sure. Again, Brent Johnson. I have a company called Santiago Capital, which is essentially a wealth management firm. I work with about a dozen different families and individuals, customizing wealth management solutions for them. I do that through a combination of separately managed accounts and private funds. And then also, we invest in some outside deals, private deals, venture capital funds, et cetera, et cetera. I kind of have a focus on macro. I love the big picture. Once we get down into the nitty gritty details, I have a number of, friends and colleagues that I kind of rely on for that. So I'm very much a big picture guy. And I kind of feel like the big picture has never been more interesting. I've always found the big picture interesting, but now it's so interesting right now. And so that's me. That's what I do.
Perfect. That's great. And I'm with you. I think right now is so interesting. For everyone watching, if you wouldn't mind following us on YouTube and subscribing, we'd really appreciate that. That helps us get up to where we can promote more and other things. Part of the reason we're having this discussion is you posted something on Twitter a few weeks ago, and I'm going to quote it, and we're going to put it up on screen. You said, if you believe an additional QE is on the way, you are secretly a deflationist. If you believe in the taper, you are secretly in the inflation camp, cause and effect. And I thought that was super interesting. Can you kind of talk through that with us and help us understand what you mean by that?
Sure. And before I get into that, I'm just going to take a step back a little bit because a lot of the work I've done publicly and put out publicly over the last, call it 10 or 12 years, has really been about the design of the monetary system, how it works, how fund flows, this currency versus that currency, what central banks do, et cetera, et cetera. And this is really a follow-on from that. And the point I was trying to get across in this particular tweet is that central banks are a reactive agency. They are not the cause, they are the effect. Now, their policies can cause things to happen, but they are reacting to what they see in the market. And so my point is if you think more QE is coming, then you believe they are going to be reacting to the deflationary forces that still exist in the economy. And so if they were to step back and do nothing, you would have massive deflation. Now, the flip side of that is if you think that they're going to taper, and you think they're going to pull away stimulus, then you're actually an inflationist because you believe inflation is here, it's going to remain, its prices are going to continue to rise, and the Fed is going to have to step back in reaction to those steadily higher prices. And so I really get this across because I think there's this huge battle between the people who believe deflation is next and the people who believe inflation is next. And I think it's a fantastic debate because I'm not certain which one it comes. I kind of get labeled into the deflationary camp, which I don't mind for a few reasons, but I actually understand all the reasons that the inflationary arguments are being made. And I believe if a few additional things happen, then we could get into this sustained inflation. But until those things happen, I'm happy to be labeled into the deflationary camp. So I hope that makes sense.
Yeah. So pull this apart for me.
Yeah.
Inflation is ever and always a monetary function, right? We hear that all the time.
Right.
And so, of course, always. It's hard to say something always is, but people love to quote that. And I think they misapply it in many cases. And I've seen that you've kind of pushed back on some people in some cases. So, can you talk us through that? And is this time different? Like, what are the considerations around inflation this time?
Yeah, so this is a perfect way to set this up because again, I understand the arguments that those in the inflationary camp are making. And it would be hard to sit here and say we haven't seen inflationary effects for the last 12 months. Prices have risen. Regardless of why or whatever, prices have gone up. So I'm not going to sit here and deny that we've had inflationary pressures. The question is what comes next? And I think what I would say with regard to the quote that you were just making, I think that was, I can't even remember who said it now, but, it was 50 or 60 years ago. And what I think was assumed in that quote was that monetary velocity is constant. And so you've seen these huge rises in the monetary base of not just the United States, but Canada, Europe, South America, China, Japan. And so the thought is that with that new money in the system, you're naturally going to have inflation. But I think Lacey Hunt, who a fellow Texan of yours, does a fantastic job of showing, had the rate of monetary velocity stayed the same, that would be absolutely the case. But the reality is monetary velocity kind of took a nosedive starting about 20 years ago and has just continued lower and lower and lower.
And it's been negative, right? For the past couple of years?
Yeah, it just continues to fall. And I think the really
Sorry, let me just stop you right there.
Yeah.
Negative velocity of money. What does that mean?
Well, what it essentially means is that new credit is not being created. And so the system is contracting. And this is really the key to it all. It's the key to the way the monetary system is designed. It's the key to the way it functions. And it's the key to whether we're going to have inflation or deflation next. Because I do agree with the money, the inflation is always and everywhere a monetary phenomenon, assuming that velocity is constant. But velocity isn't constant. And it's because of the way the monetary system is designed. And it's because of the way that the Fed and other central banks have been providing stimulus. Probably don't have time to get into all the details of what a bank reserve is and whether it is or whether it isn't money. Yeah. But essentially what the central banks have been doing, especially the Fed, is recollateralizing the system. Now, recollateralizing the system isn't exactly the same thing as actually handing somebody else physical money. It sort of is, but it sort of isn't. And it leads to this big debate on whether they're actually printing money or not. It's my argument that the Fed has been recollateralizing the system, and that has kept prices from continuing to fall. But in order to get this sustained inflation, when I keep saying sustained inflation because I don't want to deny that we've had it, but to have it continue going higher, especially at the rate we've seen, would require one of two things. Either the Congress has to come out and agree to spend another $7 or $8 trillion, which this week is showing it's very hard to get them to agree to do that. They can't even agree on $3.5 trillion, let alone another 6 or 7. Or the banks have to start lending, and the banks simply are not lending. They lent last year because the loans that the banks made last year were guaranteed by the government. These were the PPP loans that everybody got. So that money got into the system. The reason the banks made them,
you didn't get one.
Some people got them, but I didn't get one.
Just kidding.
That's right. No, I'm glad you brought that up.
So what you're saying, it sounds to me, and correct me, what you're essentially saying is that banks are failing as a transmission mechanism. So the government has had to become the transmission mechanism because banks aren't doing what their job should be. Is that true?
That's a very good way of putting it, yes.
Okay. Why? Why are banks not the transmission mechanism that they should be?
Well, they have the potential to be, and that's what I would say. The Fed has provided the banks all the kindling, for lack of a better word, all the starter fuel to create this inflationary storm. But the banks haven't done it. I would argue, now there's people that disagree with me, but I would argue that they don't want to make a loan because, believe it or not, banks don't want to rely on getting bailed out, and they don't want to make a loan where they're not going to get their money back. Now, if you're in an environment where businesses have been shut down, either because of the pandemic or because of other laws or because of regulation, they can't afford all the regulations, whatever it is, it's hard to loan somebody $1 million if you don't know that their business is even going to be open the next day, right? And so banks aren't in the business of going out and making a loan and having a default on them. They want to get their money back. And I think that they would rather go out and buy a treasury bond that's yielding 1.5% than make a loan that pays them 3 or 4 but might go bad.
Right. Okay.
And so to me, that's indicative of the deflationary forces that the banks, who are closer to the money than anybody else, and typically the people that are closer to the money understand the money or benefit from the money the most, they are telling me by their actions, maybe not their words, but their actions are telling me they don't think this is a great investment.
Yeah, I think we could talk about that point for like 20 minutes.
Oh,
So,
probably.
so
Yeah.
let's switch to something else.
Yeah.
So what you didn't really mention is the supply side of the market in terms of inflation, meaning supply chain issues, these sorts of things, right? And so I want to focus a little bit on China now. There's a lot happening in China, and I want to understand how that impacts your worldview. Okay, so in China, we've got the crypto regulation that's come in. Okay, and the clampdown on crypto, we have a strong CNY, like an unusually strong CNY over the last 6 or 9 months. We have the power supply issues. We have the supply chain issues. That's a lot happening all at one time, at a time when a lot of people believe there's kind of China has this clear path to ascendancy, but
Yeah.
I think they have a lot of headwinds, right? And so, of those kind of, how are you thinking about those factors, the crypto factor, the supply chain factor, the power factor, how are you thinking about that stuff?
So I think about this a lot, first of all. I mean, this is probably, like it or not, for better or for worse, the China-United States dynamic is probably one of the biggest macro drivers for the next 10 or 20 years. It most likely will be. No, there's nothing that's guaranteed, but that's probably a pretty safe bet that that's going to be one of the main drivers. And so I think what you're touching on as far as the supply chains, in my opinion, that is as big a driver as the quote unquote money printing for the inflationary effects that we've seen for the last year. If you look at the efficiency with which the single global supply chain achieved, call it from 1990 to 2018 or 19, it's pretty amazing, right? There was one global supply chain. You had just-in-time inventory. You could predict with a very high level of certainty when you would get those things you ordered and at what price. But then with a combination of the U.S. and Chinese antagonism and COVID, the supply chains are broken, and and that makes it harder to get those supplies. And the timing of when you get them and the price at which you get them is completely unknown, or it's delayed and the prices are higher. And so I think that has led to a lot of the price pressure on commodities. Now, part of the reason that the decreasing supply pushed prices up was that demand stayed flat or went up a little bit. And I think the reason it went up is a lot of people believed that the Fed would print enough money to cause demand to stay solid, and that China was growing and that they would continue. China has been the growth driver for the global economy for years and years. And I think a lot of people thought that China would continue to be that growth driver for these commodities and these other goods that were needed. And so if demand stays flat or rises and supply gets cut, then price rises. Well, now I don't think that China growing and ascending to economic hegemony, or however you want to describe it, is a given. I think they have more troubles internally than they would like to admit, and I think we're starting to see that. With the Evergrande real estate daisy chain of credit extension. If you think that the U.S. has a credit problem, take a look at China. They do as well, and it's manifested itself nowhere more visibly than in the real estate market there, and Evergrande is a great example. Now, the problem is if they cannot stem that credit contraction that is currently taking place in the Chinese market from a real estate perspective, then demand is not going to stay flat. Demand is going to start to fall. And if demand starts to fall, and some of those supply chain logistics start to get ironed out, now they're not going to get fixed overnight. It's not going to go back to the way it was 18 months ago. But if it even gets a little bit better and demand starts to fall, well, then you could have a move down in commodity prices and then move down in growth expectations. And that is the way deflationary pressures could take hold. And as those prices start to come down, then you get more credit contraction, and it becomes a vicious cycle, both to the upside and to the downside. But based on the design of the monetary system, and I don't need to keep harping on this, but based on the design of the monetary system, it is literally the stair step up and the elevator shaft down. That's just the way it's designed. It's an inherently inflationary system in that it has to grow or if it doesn't grow, then it crashes. And crashes always happen faster and steeper than the
Yep.
stair step higher.
They take longer, but
They
they're
take
a lot
longer.
steeper than on the way up,
That's right.
right?
That's right.
So,
That's right.
okay, so in terms of like the supply chain issues, okay, I'm just curious, is this something that you think is going to resolve itself in 3 or 6 months? Do you think it's something that's with us for 3 years, or what's
Well, so
like, what's your feeling on
I
it?
think some of it's going to resolve itself in 3 to 6 months, and I think that will be a combination of just working out the kinks and demand falling, right? I think that will help, but I don't think it's all going to get fixed in 3 to 6 months. And I think it might take 3 to 6 years to get the other part of it fixed. And this is where I have to actually say that in the past I've been somewhat critical of the people who called for stagflation, because I kind of felt like it was a cop out, right? You couldn't decide, so you just go down the middle. But I actually think that that's a very likely scenario. I think some things are going to inflate. I think some things are going to deflate, and we're going to have this kind of this stagflationary environment. I think the central banks are going to do everything they can to kind of offset those deflationary pressures. And in some cases it will work, and in some cases it won't. But the global debt, the amount of global debt and the global dollar debt in the world is so big that that deflationary scare, in my opinion, is always going to be there. And in my opinion, you can't ignore it. A lot of people just think, oh, you don't worry about it, central banks have your back. There's a Fed put, don't need to worry about it. I understand that argument, but I don't think it's correct. I think you do have to worry about it.
Yes, I think that's right. Brent, I would love to talk to you for another couple hours. I think we could do it, and I'd love to revisit this in a few months. Thank you so much for your time. For everyone watching, if you wouldn't mind following us on YouTube and subscribing, we'd really appreciate that. That helps us get up to where we can promote more and other things. And Brent, I really appreciate your time and really appreciate this conversation. Thank you very much.
Always happy to talk to you, Tony.